We all know Charlie Munger famously said that stay away from the three L's: liquor, ladies, and leverage. And in this video, you will see a great explanation of why you should stay away from the use of leverage in investing by the two of the best to ever do it.
But more seriously, you've spent a fair amount of time talking about low probability transformative events. I recall a discussion on the probability of a nuclear event not occurring in any given year for, say, 50 years, at which point it begins to look like over the time period it's pretty darn likely, and therefore the expected value is a pretty big negative. There are some other things that could be happening that somebody might expect. For instance, perhaps there is in fact a ceiling on consumer debt coverage ratios. If they quit falling, that could be a big change. If you even listen to the United States Geological Survey, they're now saying that sometime in the next 50 years there could be a fall in the production of oil. And so I'd like you to address how you conceive of the portfolio of businesses in the context of these possible transformative events, especially given that over this same time period of maybe the next 50 years, at some point you're not going to be able to personally revise the portfolio.
Yeah, I think it's a fair statement that over the next 50 years at some point, Charlie and I will not personally be able to participate in portfolio revisions. Well, you're quite correct that people tend to underestimate low probability events when they haven't happened recently and overestimate them when they have happened recently. That is the nature of the human animal. Noah ran into that some years back. But he looked pretty good after 40 days. What you mentioned on the nuclear question, it's a matter of, you can do the math easily. What you don't know is whether you're using the right assumptions. But for example, if there is a 10% chance in any given year of a major nuclear event, the chance that you'll get through 50 years without it happening, if the 10% is correct, is a half of 1%. I mean, 99.5% of the time, a 10% event per year will catch up with you in 50 years. If you can reduce that to 1%, there's a 60% chance you get through the next 50 years without it happening. That's a good argument for trying to reduce the chances of it happening. In terms of our businesses, I think Charlie and I we think about low probability events. In fact, in insurance, we probably think about low probability events more than most people who have been insurance executives throughout their year. It's just our nature to think about that sort of thing. But I would say, if you talk about transforming events or really talk about major events that could have huge consequences that are low probability, they're more likely to be in the financial arena than in the natural phenomena arena. But we'll think about them in both cases. But we do spend a lot of time thinking about things that can go wrong in a very big and very unexpected way. And financial markets they have vulnerabilities to that we try to think of, and we try to build in ways to protect us against it, and perhaps even build in some capabilities where we think we might profit in a huge way from it. Charlie?
Yeah, that temporary collapse in the junk bonds, where they got down, many of them, to 35 and 40% yields. That's a strange thing, and to have all those things pop back, quadrupling in a short time. There was absolute chaos at the bottom of that. And that isn't as much chaos as you could have And of course, it can happen in common stocks instead of junk bonds. So I think if you're talking about the next 50 years, we all have to conduct ourselves so that it won't be all that awful if a real financial crunch of some kind could come along. Either inflationary or a typical deflationary crunch at the time that people used to have a great many decades ago.
Probably the most dramatic way in which we give evidence of your worries is we just don't believe in a lot of leverage. I mean, you could have thought junk bonds were wonderful at 15% because they eventually did go to 6%. You would have made a lot of money. But if you owed a lot of money against them in between, you wouldn't have been around for the party at the end. So we believe almost anything can happen in financial markets, and the only way smart people can get clobbered really is through leverage. If you can hold them, you have no real problems. So we have a great aversion to leverage, and we would predict that a very high percentage of the smart people operating in Wall Street at one time or another are likely to get clobbered through the use of leverage. It's the one thing that forces you, or it's one thing that ends or can prevent you from playing out your hand. And all of the hands we enter into look pretty good to us, but you do have to be able to play them out. And the fascinating thing to me is that, just take the junk bond situation. In 2002, you had people with a terrific IQ, tens of thousands of them operating in Wall Street. You had the money was available. They all had a desire to make money. And then you see these extraordinary things happen in markets, and you say to yourself, can these be the same individuals that 2 years later or 2 years earlier were buying these things at prices that were double or triple or quadruple what they sunk to in between? And did they all go on vacation? Did they lose their ability to raise money? No, the money was, Wall Street was awash in money, and it was awash in talent, and yet you get these absolutely extraordinary swings. I mean, it doesn't happen with apartment houses in Omaha or, with McDonald's franchises or farms or something, but it's just astounding what can happen in the marketable securities department. And the big thing you want to do is, at a minimum, you want to protect yourself against that sort of insanity wiping you out, and better yet, you want to be prepared to take advantage of it when it happens.
Leverage, despite its attraction, represents a significant risk to investors, especially those who are not deeply experienced. Buffett and Munger's advice highlights a key truth in investing. The chance for high returns often comes with high risks, particularly when leverage is used. Leverage increases outcomes, for better or worse, and can turn small market changes into huge amounts of losses, forcing investors to sell at the worst possible time. Their stance on leverage reflects a broader philosophy that values patience, discipline, and looking at the long term. This approach represents a wider investing wisdom that puts steady growth and keeping your capital safe over risky gains. It is a reminder that the most successful investors are not those who take the biggest risks, but those who are the best at managing the risk. Munger's example of the rapid fall and recovery in the junk bond market serves as a clear example of how quickly fortunes can change in the financial markets. It is a great reminder of the chaos that can happen when market conditions change unexpectedly, and leverage makes the impact of those changes even bigger. This is not just true for junk bonds. Common stocks and other securities can just as easily see huge amounts of swings, making leverage a risky tool in the hands of the inexperienced. The key message from Munger and Buffett's discussion is the importance of being able to stay in the market during volatile times. By avoiding leverage, investors can make sure they stay in the game, able to survive financial downturns and take advantage of opportunities that come after. This ability to stay resilient allows investors to stick to a well-thought strategy without being forced into bad decisions by the outside pressures. Also, Buffett's observation that huge market swings can happen among individuals with significant resources, and intelligence is a humble reminder of the market's unpredictable nature. It highlights that even the most knowledgeable investors are not safe from the market's unexpected changes. In conclusion, it is always extremely important to remember that successful investing is not in trying to outsmart the market, but to position yourself to take advantage of the market's huge swings. By staying away from leverage and adopting a disciplined, long-term approach, you can align yourself with the principles that have guided some of the most successful investors throughout the history. In doing so, you may not catch every short-lived chance for big gains, but you will protect your capital against the kind of huge losses that can throw off even the most promising investing path. That was it for today. I hope you liked it, and I'll see you in the next one.